I kind of said I thought it would be right around there, about 3/8 lower than where we are sitting today. They were saying appreciation was going to be at about 4.1%. Now they're saying appreciation is going to be at about 2.8%. The credit card debt in this country is the highest it's ever been. And along with kind of forecasting unemployment and seeing where employment's kind of heading. So, this signals modest tightening in credit access, right?
I'm Karl Kyler, your San Diego Realtor, and we're back with Matt.Kish from Movement Mortgage. Matt, thanks for joining us again. Let's just jump into this. Interest rates haven't really moved that much since we last talked.
No, they're pretty much stagnant. Like we said, unless there's a good day of news or a bad day of news, there really hasn't been too much movement in the bond market. Maybe once we see kind of where these tariffs go, there might be a chance where we could see the pendulum sway one way or the other. But as far as interest rates are concerned, they pretty much for the last 2 months they've wiggled and moved a little bit up and down. But if you take a look and you widen out the view, it's pretty much flat.
Yeah, I was surprised with some of the trade deal, like the trade deal that we got with Japan, and then some of the war stuff that escalated. I'm surprised that we didn't see a little bit more volatility over the last 2 weeks, but I think that ended up being in our favor because having that lack of up and down allowed some buyers just to kind of like secure right now rather than like it being, 6.62 and they're like, oh my gosh, I can get it now. And then 2 days later, it's not that because they didn't have their pre-qual in place or whatnot. So anyways, that's really, really good. Let's jump into my first major question here. Fannie Mae had a forecast. Fannie Mae, one of the larger investors or loan providers, right? They had a forecast that rates would be down to 6.5 by the end of the year, but they upgraded or updated, I should say, that forecast to 6.4% by the end of the year, which is interesting because right now we're, based on Mortgage News Daily, we're hovering around like 6.8 and they're saying we're gonna be down to 6.4. So I'm wondering, that seems like a big jump for me. Now, obviously you're gonna give us context, but for me, that sounds like a big jump for us to accomplish in the next 5 months. Can you give us your insights? Is this something that you agree with? If it is, or if it isn't, tell us why. And then also, like, what needs to happen exactly for that forecast to actually be met?
Yeah, if you rewind our tapes from a few weeks back, a month back or so, I kind of said I thought it would be right around there, about 3/8 lower than where we are sitting today. But again, like we said, it's all about trending the right way and keeping the progress as far as inflation, as far as GDP growth, as far as the 10-year note. Fed policy, keeping Fed policy on the tracks and going forward, whatever the policy may be, right? We really haven't got any policy that's going to be like, all right, that's the policy, that's the direction we're going. The train's on the track and now we're moving. We would like to have a little more consistency in that. And housing demand, right? And I think the housing demand and the way Fannie Mae was looking at appreciation to start the year, they were saying appreciation was going to be at about 4.1%. Now they're saying appreciation is going to be at about 2.8%. So I think that really curtailed the way they're looking at where rates are going, demand, where inflation's going. Inflation is actually kind of where they want it to be. GDP growth actually has to get a little better. They would like to see a soft, steady growth. Definitely a little better than what we saw in Q1. And then the big one for us, and like we've been talking about since we started this thing, is the 10-year Treasury note. Getting that closer to into the threes than hovering in the mid fours on the 10-year Treasury is really going to make these interest rates take a bump down. And they're also forecasting what the Fed's going to do maybe in September, October, November, if they start making rate cuts to the Fed fund rate, what that may or may not do to interest rates, hoping that not having the yield curve inverted this time around may help mortgage rates.
So from 4% down to 2% growth in pricing, with that forecast coming down, how do you think that is affecting their forecast with rates? Like, why is it that if appreciation growth comes down, that their forecast for rates would, now mind you, it's very minuscule, 6.5 to 6.4, but how does that affect that, you think?
I think they're kind of looking at the unemployment numbers on that. If we're honest with you, they're kind of seeing what the economy is doing, right? So there's no need to really hit the brakes if the economy's slowing down. There's really no need for the Fed to keep their foot on the brakes on this one. So they could kind of, ease up, give a little back to us as far as the consumer, lower the interest rates a little bit and put a little bit more money in our pocket, knowing that the economy is kind of slowing down a little bit. They don't want it to slow down too much.
Could you give us any insight on how it is that you're advising your clients in this context? Like, we have these forecasts that are regularly being adjusted from, I feel like every 4 to 6 weeks they're being adjusted based on new data that's coming in, which makes sense. How are you advising your clients right now? Like, should they hold off and wait till rates come down? Is it a scenario where you are locking them in and saying, hey, just sit tight here for a short period of time and then we'll refi down the road? How is that conversation coming up for you between you and the client with let's use the word volatility, the volatility of the direction where the market's actually going?
That's a great question. And we're actually having both conversations, right? What does it look like going in now and refining here in 8 months, a year, 6 months? What does that look like, right? Option A, option B. And then what does it just flat out look like to wait, right? What does it look like with home prices kind of bumped up a little bit now that we're waiting and interest rates are lower? Now everybody has this news. This news is ready and available to anybody who searches the interweb, right? So if you're really interested in what the economy, the housing, and stuff like that, this information isn't hard to find. So a lot of people who are sitting on the sidelines are privy to the same information that me and you are looking at, and they're licking their chops and really getting ready to pounce. But what does that look like in home values when that does happen? And are we prepared to sit on the sidelines and wait for that price to jump up and maybe hope that interest rates come down? Or get in now? What does that look like? Get comfortable with maybe a temporary buy down in the interim, and then pounce on the refinance option once we could do that. You're already in your house, you're already comfortable. So again, we like to have all options on the table. We like to have all the conversations, and we're having both. And we have the software too to show you in real time the cost of waiting and what does it look like now compared to prices today, and if we refinance a little bit down the road. And it's all about comfortability monthly. It's always going to be that, whether the rate's 2% or 10%, and the home price is $1 million or $100,000. Are you going to be comfortable with that monthly payment? What does it look like now? What does it look like going forward?
Got it. That is something that is so very important for the consumer, the buyer, to be mindful of. Is I really like the approach you're taking with this, in the sense is like, hey, let's look at comfortability with the payment right now. If it's the case, or when it becomes the case that you can refi, we'll take advantage of those opportunities. And this is what it could look like. But right now, how comfortable, challenging word for me this morning, how comfortable are you with the payment at this moment? So that's really, really good. I like that you're offering this education, the possibilities of what could surface once volatility maybe settles down a little bit, and at the same time showing them the opportunity that's actually present in the market at this moment. Because I heard an economist suggest that when rates get down to 6%, because everyone's super confident that that's going to happen, they're talking about the number of buyers that will be opened up to the market right now. And one of the best things he advocates for, this economist I follow, is keeping rates where they are, because it's sustaining prices. It's capping price growth, which is allowing incomes to come up naturally and kind of meet us where prices are, rather than cutting prices, increasing affordability, and then these buyers rushing in thinking that, oh my gosh, we got to get in now. Then you get buyers rushing the market, then you get buyers competing, and then prices just get jacked up again.
Yeah, obviously we're always going to have that conversation, but we're always fighting against the hypothetical, right? It's always rates are going to be this, rates are going to be that, home price would be this, home price would be that. We just got to get ahead and in front of these folks and answer these questions with real live numbers, right? Okay, yeah, let me answer your hypothetical with the figures and let you take the wheel, right? It's like, I can only do so much. The decision's yours.
Beautiful approach. So let's move on to the next topic that I think is going to be really, really important that you can maybe shed some light on for the audience, especially a lot of the buyers here. Not that this doesn't affect sellers as well, but the Mortgage Bankers Association recently reported a decline in, help me if my wording is off, but essentially like a restricting in loan policy or loan conditions and a decline in credit availability. So it sounds like what they're doing is they're making some loan programs harder to get into. And I'll use the term very loosely, harder. I'll use that loosely. They're making some programs harder to get into, and maybe they're even scaling back some loan availability. Can you tell us any insight on something like that? Because I hear that this is the first drop that the Mortgage Bankers Association has had. I think it's this year.
That's very true. This is the first drop they've had this year. And we've kind of been talking about it a little bit too, about like the credit card debt in this country is the highest it's ever been. And along with kind of forecasting unemployment and seeing where employment's kind of heading. So, this signals modest tightening in credit access, right? Here at Movement, we're usually forward thinking. So when we see other people kind of close up their tents, we see that as opportunity. But there is some truth in this. You're going to see some folks tightening their reins as far as credit access to maybe if you were 620 on a credit score, now you got to be a 640 to get certain programs. Again, I'm not seeing it here personally, but we're hearing about it, especially now when you see the first flag drops here. Oh, the first time in 6 months, this is the news. So you're going to see a lot of people start tightening up, and now this might even snowball into something that we see a little more of. This is the kind of the first hat to drop, so there really isn't much buzz in my world about it yet. But like me and you have been talking about, this is kind of something we've been kind of foreseeing for a little bit, knowing that the debt in this country, as far as credit's concerned, is the highest it's ever been.
Yeah, I remember in 2008 when we peaked and then everything went down, it seemed like there was only 3 loans available: VA, FHA, or 20% down. Like, loan restrictions got so extreme because of the volatility of the market, the downward trending of the market. Figure we bottomed in 2012. Banks wanted people with cash that can afford houses, and so we really had just three loan options back then that I can remember that were how people got into homes. Can you give us any insight? Like, it sounded like you gave an example of like, some loans where their minimum credit score was like 620, now it's 640. That seems like a pretty small shift right there. Is this just like, I don't want to say the tipping point, but more so like preventative care measures that maybe loan originators are taking, where they say, you know what, let's tighten up our guidelines just a little, start qualifying our buyers a little bit more as a preventative care?
That's exactly right, Karl. And that's kind of, like I said, this is the first hat to drop, right? So this is the first number, and now you're going to start seeing folks react to it, right? Again, we haven't really seen it on our end, but we, being in this profession, like you said, 2008 all the way to 2012, it was kind of wonky as far as lending was concerned. But again, there's always going to be nuances as the economy grows, shrinks, or stays, somewhere in between. But in this sense, you will see some maybe streamline options be taken off the table. You may see some cash out options get a little tighter. You may, for lower credit and or income borrowers, you may have a higher cost to obtain a rate. But again, there's always going to be tightening as you see the economy, shrink a little bit and tighten up, as we, talked about in the first question. So this again is just a recourse of that, right? You're going to see a lot of things, get a little smaller when it comes to the economy slowing down.
You bring up some really good terms there that I think the audience may not know. So let me just dive into them. You're referencing some of the programs that may be taken off the case, or let's say become tighter with qualifying for would be like cash outs, which happened when the 2008 to 2012. I remember when people had home equity lines of credits, banks just shut them off. They just said, oh, sorry, we're not doing this anymore. You said streamline. So I hear a lot with streamline refis, where it's just like an accelerated pre-approval and a refi situation. So some of those programs, so this could not only affect buyers, but what I'm hearing is that it could also affect homeowners that are looking to do cash outs, loan modifications, I shouldn't say loan modifications, I should say loan refinances, or even HELOCs. Am I hearing that correctly?
Yeah, that's absolutely correct. And you know, the purchase side is one side of lending, but again, if you already own a home and you want to do a refinance, you want to do and change your rate, you want to get a home equity line of credit or a fixed second to build an ADU, you're still going to have to qualify for these things. And if you lost your job, that's going to be hard to get financing going forward, right? So you're still going to have to qualify for these new loan terms. And if for some reason something happened in your economic scenario, the bank's going to really look at that and be wary if they're going to lend you the money that you're looking to transact on. And again, being these streamlined refinances or anything streamlined, they're not going to dive into a lot of your income or your assets as much as you would in a normal transaction. So they're really going to put a cap or a limit on things like that if you see these changes and these numbers with credit continue to get worse.
All right, so we have this early signs of some adjusting on the loan side of the market. They're tightening up. They're saying, okay, hey, let's do some preventative care here. The hat's dropped, I think, is the analogy that you're kind of referencing, or the metaphor you're referencing earlier. How should we agents and lenders how should we be moving forward with the conversation with our clients in this regard? Is anything changing in the conversation? Should I be changing anything I have in the conversation with my clients? I shouldn't say typically, 99% of the time I talk nothing about loans. I stay in my lane. Like, I know the real estate side. I know how to help you find the house, identify the house, inspect the house, and decide to move forward and negotiate on the house. Everything with the lender on the loan, I defer. Call Kish, talk to Kish. Kish will answer all those questions. Like, I want to stay in my lane. I don't want to put my foot in my mouth and like overstep my boundaries and make you look bad or overpromise something that you can't deliver on. And it just makes the whole thing situation be kind of, it just makes the whole thing fall apart. Is there anything that should be changing in our conversation, my conversation, or your side with buyers, or anything that buyers should be mindful of right now as these things are kind of adjusting?
It's always going to be, for me, it's always going to be the same conversation, right? And it's always going to be the 3 C's: credit, collateral, capacity to repay the loan, right? That is always going to be the pillars of getting financing, whether you're buying or refinancing or however you're looking to obtain a loan and whatever it's for. But that's always going to be the conversation is how's your credit? Have you had your credit ran? Are you paying your bills on time? You always, as a real estate agent and to help us out, you always kind of want to vet your peeps. You're going to want to, hey, do you got good credit? Hey, have you been at your job? How long have you been at your job? Is over 2 years? Oh, that's great. Salary, or are you on an hourly commission? These questions up front really help us out because we could really get the ball rolling and have that conversation. And it also gives you guys, if they, answer a question, I had a bankruptcy last year, that's really going to put a hold on this process and really, you don't want to find that out 3 weeks later, right? After you've been showing these folks a couple houses, a couple condos, to find out they had a bankruptcy last year. And now we got to wait for this whole process to keep going. Not to say there's not programs out there that could take care of that. I'm just saying that's not the best scenario to be in. And you want to know that up front. There's things that we could really, and small questions we could help each other out and answer and get answers for up front. Being partners, and you always kind of want to vet your peeps about those 3 C's: credit, collateral, capacity to repay the loan. it's going to help you out in the long run as well. You definitely want to know that you're hanging out and showing places to somebody who's qualified to buy it.
Matt, thanks again for showing up and giving us this update. We do this twice a month to keep you updated on not just what's happening on the real estate side of my channel, but also to keep you updated with what's going on the mortgage side, right? Because they're interconnected, right? So if you have any thoughts, questions, concerns about the loan market in general, just give Kish a call. His contact info is in the description below. Kish, do you have any closing thoughts or anything you want to leave the audience with?
Yeah, I would just say stay the course, right? There's a lot of information and we're giving you tons of information and hopefully helpful. But if you're wondering about, buying a house or what that looks like and you're on the sidelines, stay the course. Credit, collateral, capacity. If you have those three things in line, there's no reason why you shouldn't be in a house, regardless of the rate environment, regardless of the economic environment. Give Karl a call, give myself a call.
Very well said. As always, I'm Karl Kyler, your San Diego Realtor. We'll see you in the next video.